very much to be here. Horrible weather outside. I would suggest we start the panel with an introduction of who our speakers are here. And over to you.
Yeah, absolutely. I'm Clara Tsao, founding officer of the Filecoin Foundation. For those that aren't aware, Filecoin is the world's largest decentralized storage network. And we're really excited about this panel today because a cornerstone of RWAs is really verifiable data and that information layer that everyone can track, trace, and audit. And we just launched Filecoin on-chain cloud this week, which really allows for on-chain payments plus smart contracts. So really excited to see a lot more explosion into the RWA market from our ecosystem.
Hey everyone, my name is Chunda. I'm one of the co-founders of Paxos Labs. It's the newest initiative out of the Paxos group. We focus primarily on building infrastructure to enable enterprises around the world to build out crypto capabilities. We focus specifically on the lab side on generating stablecoin yield for enterprises as well as borrow lend capabilities for enterprises.
Hey everyone, my name is Jay. I'm co-founder of Sei Labs, and we're building a general purpose EVM L1 that went live on mainnet 2 years ago.
Hi, my name is Kevin. I'm the founder and CEO of Goldsky. We run the data platform for on-chain finance and apps. We power over 1,000 businesses, Polymarket, Coinbase, Uniswap, Circle, and counting today. We've grown quite a bunch since then.
All right, amazing. We have an amazing cast here. And I want to kick off this discussion by pointing out that we've discussed in crypto real-world assets for years, but this year things really took off. I want to ask you guys what changed and where are we going from here?
Yeah, I mean, I can kick us off here. I think, and this is something we saw a lot in our enterprise conversations at the end of last year. Honestly, a lot of it was regulatory appetite for kind of being open to some of these new products. I remember, right after the close of the election in November of last year, top of the year, we had pretty much our entire pre-existing client base on the Paxos core side came out and said like, hey, like what else can we do? Can we do more? And these are enterprises like, PayPal, Interactive Brokers, Nubank, even companies like Mercado Libre here. We're basically asking like, hey, like what more can we do outside of just buying crypto and having crypto on our platforms? And so I think really it was kind of the regulatory shift that moved the needle a lot for people to be comfortable really pushing those initiatives internally.
I wanted to just add on top of the regulatory change, we also saw a lot of large institution along with that really start looking at RWAs because of yield, and when Blackstone with their Biddle fund and a few other major institutions moved in, I think that created a lot more wave of confidence that obviously led a lot of growth and interest. But I think, honestly, there's still a lot of lag right now in terms of just the dominant force still being treasuries and other kinds of capital. So we're hoping that we can see a lot more retail interest that comes with time. But I think the markets have also been really favorable in crypto, especially this last year, for a lot of yield generation across the board. So I think that's really where you see a lot more market confidence as well.
Oh yeah, I was just going to echo the thought that it is entirely tied to the election, I think. The election kicked off a lot of regulatory changes, and I think things like the Genius Act and in the future, hopefully the Clarity Act will all help set the stage for a lot more innovation that can happen tied to that.
Yeah, speaking of the yield aspect of it, right now if we discount stablecoins, real-world assets are completely dominated by treasuries and private credit funds. What's driving that growth? Is it just yield chasing?
Yeah, I think it's a lot of it for sure. I think if you look at kind of like the broader macro, right, rates are getting cut, not only in the US, but also throughout the world. So at some point, in order to kind of continue the returns that people have been seeing over the past few years, people are looking for bigger opportunities. Now some of those opportunities live on-chain.
Yeah, and I think a lot of the impetus on the institutional side was driven by this kind of new window of regulatory arbitrage that exists, specifically around the concept of global expansion. If you think about you kind of this backdrop of an appetite for yield that you talk about, right? Let's say you, as an institution, know that this is going to happen, right? There's going to be this increased appetite for yield. what would that process look like of spinning up the ability for, enterprises in, let's say, a new jurisdiction? Let's say you're an American fund and you're doing it in, I don't know, Korea. What does that process look like? It's months, potentially years of regulatory approvals, of standing up payment flows and all that work. Or you can go tokenize an asset, work with distribution partners, and get plugged into that region, right? And so the ability to be able to facilitate global expansion of these kind of pre-existing structured products, and kind of this more like regulatory like favorability of these types of products in especially even these regions as well is really kind of what talk a lot of these fund managers. That's kind of what opened their eyes to the concept of tokenization.
Yeah, amazing. Given that you talked about regulatory hurdles, real estate has always been one of the major use cases for real-world assets, and it's struggling to take off. What's behind that struggle?
Yeah, I can kick off. We've actually worked with a number of companies in the real estate space who have used Filecoin as that verifiable layer. Proppy is one of them. But I think one of the challenges in real estate is it's unfortunately still a very old school market where a lot of transactions already happen off-chain, and it's also very slow moving. And sometimes, depending on, again, the regulatory environment where you're taking place, it's just a lot harder to convince people to really innovate in that space, which is why a lot of processes, even outside of Web3, in Web2, are still very slow when entrepreneurs are trying to build new companies that disrupt real estate. But I think one of the best parts about real estate and the opportunities there is, again, a lot of real estate transactions need to be reported, they need to be verified, and people want to make sure that these assets, online and offset, you can actually prove over time that you're still owning and being able to access that credible source of information. And that's really where decentralization in RWAs can play a really key role in making sure that people can have democratized access to these kind of financial assets.
Yeah, I think it's just really hard when you have like a physical object that is non-fungible to be able to build some kind of like financial markets easily on top of that on-chain. Realistically, the way this is going to play out is it's going to start off with simple financial instruments, which we're starting to see already. Treasuries, equities, private credit, these are already very easy for us to tokenize and start doing things with. On top of that, I think we're going to start having, because everything is composable, we're going to start having more complex instruments or more complex things based on top of that. And I think that's what's going to drive more things such as real estate to start eventually coming on-chain.
Yeah, I just want to add on to that. I think ultimately it's just harder. Like it's just way more complex, right? If we're just talking money, if the money shows up in the account at the end of the day, great, everyone can tell what kind of happened. When you're looking at like a real estate transaction, it's way more complex, right? It's like who actually owns it. It could be multiple people owning it underneath. I think the reporting requirements alone are just way more involved than just money moving around and getting yield.
Yeah, so the advantages are fairly obvious given the transparency of blockchain technology. So how do we face those hurdles to bring real estate on chain?
Well, if I survey the room here, who here owns a house or has bought a house before? Okay, that's like probably less than 50%. But I think some of the challenges, actually a lot of the crypto community is nomadic. And I think a lot of innovation comes with the pain points that a lot of entrepreneurs in it day-to-day have to face. I think a lot of people, as we see more TradFi and traditional people come into crypto and are able to innovate on top of it, that's really when you're going to accelerate that innovation, because a lot of the real estate entrepreneurs that are exploring RWAs that I know, they've spent most of their careers, again, in traditional real estate. So they know the processes inside out, but I actually think that funnel is still quite small. There's a lot in actually Miami where I live, but I think we really need to also make sure that we get the right kinds of entrepreneurs really building in Web3 as well to really navigate what Kevin had said, the complexities of different processes that you need in every single step that today, unfortunately, is still very manual like the insurance industry.
Yeah, I would actually take the other bet here. I think a lot of us, obviously all of us, want real estate to get tokenized, but I actually don't think it's the next hurdle that will get tokenized. I think it's actually far more likely that insurance will actually be the next kind of hurdle that people come after. Because if you think about it, right, we already have a bunch of really cool stuff. Like, I'm sure many of you in here have heard of Morpho, and it's doing quite well. And pretty soon, it wouldn't surprise me if you see a lot of more traditional finance institutional money come into Morpho, right? But when they do that, they're going to ask questions like, okay, well, you know, which of these vaults should I actually put my money in, right? And not all the vaults are going to work out. If something's going to go wrong, who actually pays when that happens? Is there like an insurance fund? Is there a reinsurance fund for those insurance funds? I think that's actually a huge market that will probably be the next kind of area of exploration rather than real estate, which again is still extremely complex.
Building on that, we currently have Nexus Mutual, decentralized insurance protocol, but its adoption is rather low and it's kind of a niche product so far. So how can we mainstream that product given the current adoption rates of DeFi?
So Nexus, it's funny, I used to work at a fund that we invested in Nexus back in the day. Nexus was a first of its kind when it came to building out insurance on-chain. The historical problems with on-chain insurance were usually around the kind of one-sidedness of kind of like what induced the payoff function. So more specifically, most traditional insurance vehicles that exist to date on the market on-chain have been around like smart contract risk. And the problem with insuring against smart contract risk is if you were to actually price out those premiums, it would outpace the yield rate that you would generate of pretty much doing anything outside of the most riskiest trades on-chain. Where you get the possibility to actually introduce insurance is when you're insuring against not like tail risk events, like smart contract risk is similar for anyone in the crowd who knows about like cat bonds. Similar why cat bond premiums are so high. It's like similar like tail risk underwriting. But if you were to find a solution around on-chain insurance, you need to be able to underwrite insurance risk in a market that actually is able to generate a premium that's still justifiable for most underlying yield strategies. And I think the most underrated thing about lending insurance in particular is an insurance amount that doesn't require you to cover the full amount of principal. When you think about a lending pool, right, the biggest thing that you want to primarily insure against is probably some portion of the book getting liquidated against, and you can calculate that relatively easily through things like tracking liquidation discounts and all these different types of things in historical modeling on like one-day volatility, et cetera, et cetera, et cetera. And so you can end up in a position where $1 of insurance can really cover a book of, let's say, $10 worth of outstanding loans. And when you have a premium ratio like that, then paying out 5% nominally to an insurance fund is internalized as 50 bips on a lending position, and now that makes a lot more economic sense, right? So I think it's just been difficult historically for on-chain insurance to find a match with the right markets to insure, but especially as we're going to have more enterprise integrations on the lending side, which we're already seeing, and we're focusing a lot on things like on-chain insurance and like things like calculating risk premiums is a really big focus that will actually enable the growth of that market.
Amazing. Moving on to another subject. Right now, the largest funds are institutional, the largest real-world asset funds, that is. I want to ask, are we just bringing TradFi on-chain rather than revolutionizing the system?
I mean, it's definitely going to start off by bringing TradFi on-chain. But one thing to note is that whenever you start tokenizing things, it becomes much easier to offer things to the normal person. So I think with Securitize, you're starting to see 50K, 20K, 10K checks or 10K investments that people are able to make. So I think just broadly speaking, we're going to start seeing a transition where more and more people are able to access these financial markets. And especially once you start having layers built on top of that, it's going to be even easier and easier for people to interact with it.
Yeah, I think the early institutional adoption is great just to bring long-term retail interest, even though we're still early in getting there. But I think at the end of the day, it's also helping these everyday retail people trust crypto again, because I think 2022 there was a lot of overall sentiment and distrust, and ultimately, if we need to democratize who can actually access these, we really need retail trust at the end of the day, and a lot of that comes from the whole of crypto community. making sure that everyone's a good actor.
Also, I think I think openness is definitely a thing of kind of the new system. But everything that's ever been built has never been like, well, let's go and rebuild the same thing over again, but slightly better, right? It's not like we talk about, wow, those horses are really fast. Let's just get even faster horses and call it a car, which is ultimately what did happen in the end, right? I would actually look more to like what are the interesting kind of new things that can be built, right? So one thing that happens as a result of much of the world moving on chain is actually just capital velocity, right? Capital velocity becomes very, very fast. I don't think we've actually fully understood the implications of what that means in a future world, right? But long ago, I was part of 0x, and I remember the founders of 0x saying, one day we're going to build a world, a tokenized world, where all value will flow freely. I remember thinking back in 2021, I was like, that's an insane vision. I don't even know what that means. But now, we look at it, and every day we're getting a little bit closer. And we're kind of seeing the implications of that as it relates to how it affects the financial markets, but also some of the real world markets.
Yeah, and to add what Kevin just said, especially here in Argentina, this is a prime example where you see capital get really stuck in traditional institutions, and everyone has, I think there's a 35% adoption in the population for crypto, mainly because there are so many bottlenecks in their basic access to capital. And there's also limited investment in even people being entrepreneurs, because I was at a dinner last night asking why there aren't any kind of unicorn Argentinian entrepreneurs. And at the end of the day, it's really financial systems in different countries that act as those bottlenecks. So I completely agree with Kevin. If you can access and allow capital to flow more freely, openly, and quickly, it creates a lot more opportunity.
Yeah, I mean, even putting Argentina aside, like, I used to work at Robinhood before, and in the US there was this concept of T+2 settlement before, which led to the GameStop saga. And in that case, I mean, it basically used to take 2 days for trades to settle. So Robinhood needed to put up $3 billion of collateral with the counterparty. Stuff like that really shouldn't exist anymore in like 2021, and definitely not in 2025. So I think the speed of things to be settling will actually allow for a much more easily accessible financial system that will prevent issues like the GameStop saga from happening again.
So I think the lingering question here is how do we get that capital flowing given the regulatory hurdles that we're currently facing on these institutional funds?
I think a lot of it is less actually hampered by regulation and more hampered around building markets between these assets. So if you kind of look at the timeline of capital flows, like RWA capital flows on chain, right, we went from nothing, let's say 2 years ago, pretty much nothing, to doing a lot of primary issuance being, getting these assets like on chain. And all of that has happened in the past, give it 12 to 18 months. And so the barrier to building active capital flows between these assets is, well, we haven't built markets that are specific for these assets on chain. It's not like you can go throw BUIDL into a Uniswap AMM and like call it a day, right? BlackRock's not going to use that. And no one who's a client of BlackRock is going to use that, right? And so it takes time to build out the kind of corresponding infrastructure for the specific primitives that are required. And I think what we're seeing now is, a little bit of a lag, but, give it, another 12 months, I think realistically you're going to have a lot of these markets be stood up that enable this capital flow for this type of asset a lot more fluidly on chain.
I was just going to add, in a lot of RWA markets today, there's really limited interoperability. And so I think a lot of people that are working in that space, it really is also the plug and play to make sure we can scale it.
I also had one more thing here, which I think the problem kind of is solving itself in that a bunch of countries now are kind of looking to this going like, wow, if we do this right, we can actually come out quite far ahead. I was talking with someone yesterday at an event I met, and they're somewhat deep in the Panama ecosystem as it relates to finance. And they told me an insane fact, which is that if you open a bank account, I don't know if this is like retail or institutional, the bank account will actually have like a wallet connected to it for you now. You don't even need to go and set up one yourself. right? And I think part of the adoption comes down to, obviously the Panama Canal is like a very important trade resource. Their ultimate goal is, how do we get ships flowing through this canal as fast as possible, right? So if the more time, the less time they can spend on doing, for example, like Forex and interchange, the more ships flow through the canal, which means the more money Panama makes as a country, right? So they're actually very incentivized to solve this problem, so that ultimately, Panama can continue to kind of rise in the next 10 years.
I feel like that ties a lot with the current DeFi mullet trend, where we're seeing DeFi get integrated into everyday applications. So I want to ask, in the future, are we looking at banking accounts that use blockchain behind on the back end?
I mean, 100%. That's our entire core thesis at Paxos, right? Our literal entire company is built upon this thesis that you can build crypto rails and integrate them with enterprises, and you'll never know a thing, right? If you go on Stripe right now and decide to accept stablecoins, it's just signing up for an API, and then you're actually running through our banking rails that exist and do all of the complex transactions and all of this flow through secondary counterparty liquidity providers, and you don't see a thing. Someone just swipes a credit card that has stablecoins, and you get paid. Simple as that, right? And that type of connectivity is absolutely the next step for DeFi. And we're just going to see more and more of this, right? You're going to be able to go on, Venmo and borrow stablecoin PYUSD against your Bitcoin. You're going to be able to go to your Robinhood app and trade with stablecoins, right? Like, all of these things are an inevitability. In our perspective, it's just a matter of kind of how long it takes for it to happen, and what exactly do those implementations look like, and more interestingly, what enterprises decide to take that first step first. And that is where I think a lot of the interest lies, in just seeing who gets ahead by innovating quicker. And also, I think there's a lot of room for incumbent companies, especially that are more crypto native or understand the power of these primitives a lot more distinctly, to be able to jump ahead and take market share away from some of these incumbents that will be a little bit slower to adopt.
Yeah, I mean, just one other thing to add there is, I definitely think it's going to be a gradual process. Like, it's not going to be the US banks that are adopting this tomorrow. I think it's going to start off by being a lot of overseas entities that become more comfortable with this before, like, more sophisticated financial institutions start adopting this. So I think it will be a much more kind of longer term process than just happening pretty quickly.
Yeah, we just saw, for example, Aave launch a savings app with blockchain on the background. And I'm assuming people who adopt that aren't going to realize that they're using blockchain technology for their savings. And we were talking about trust earlier, and I want to ask, what is the biggest potential black swan event that real-world assets can see, and how can we prepare for that?
Yeah, I think as more and more assets move on-chain, I think the risk is that off-chain asset may or may not be monitored. And at the end of the day, I think this is why the infrastructure layer, especially storage, is so important, is being able to consistently prove that that asset is still there, that you can track it over time, and that someone hasn't manipulated documents, deeds, or anything along the way that changes that original form. Because I think there is also a very high risk, in my opinion, that as things move on-chain, the off-chain asset, people forget to really manage and monitor that.
Yeah, I was going to say 100%. If you look historically about what are the black swan events that happened in crypto, you really can only point to one that was actually an on-chain failure, and that was Terra. But we look at Celsius, we look at FTX, we look at, let's bring out Mt. Gox back in the day, right? Like, all of these events happened in centralized systems with a lack of transparency that had security, accounting, underwriting, or just downright fraud occurring behind the scenes that was not brought up to light because it wasn't on-chain. And so I think the biggest risk we have is we're basically reintroducing that kind of risk all over again. And so we just need to learn from the mistakes of the past and not treat this as something that we haven't experienced previously.
I actually think another thing here, I talked earlier about how capital velocity is kind of increasing, right? I think there are certain risks to that too. For example, I would actually argue that a lot of the reason why I think retail volume has been quite down this year is because too much was extracted in Q1 of this year. Right? And that has kind of reverberations and kind of repercussions where it takes maybe longer for people to come back. Right? So I think, again, a lot of these are questions that we haven't fully maybe thought through yet. Like what happens in a world where everyone can freely trade basically their entire life savings at like the drop of a pin, right? Are there potential safeguards that we need to introduce? I think we haven't really thought about that maybe as an industry nearly as much, but we'll probably likely see some of those coming out quite soon.
Yeah, I mean, one thing that hasn't really been discussed yet is tied to security exploits, and then also potential like loss of funds tied to more crypto native things. And I think there's a lot of problems that are going to emerge that are more crypto native. For example, if there's a smart contract exploit that happens, there's a bunch of new tokens get created for some asset, those are misused, and that can like have pretty massive repercussions for the entire like financial system built on top of that. So I think it'll be tied to more of these crypto native exploits or security things that we'll see.
Speaking of those crypto native exploits, we've had the Ethereum DAO hack, and we've had exploitative innovations like flash loans at the time. Could these affect real-world assets, and could these also affect trust from retail investors when their adoption grows?
I think a lot of it depends on how quickly you're able to respond to these activities happening. Because yes, I mean, there's the crypto side of it. There's also the social consensus layer of it. If the social consensus layer is able to react to security exploits that happen quickly enough, then maybe it will not have too negative of an impact. But I don't think it's going to be as instant as people would hope for. So there likely will be reverberations that people feel from any kind of on-chain event that happens.
Yeah, although I think that will exist when it comes to the form of leverage, but a lot in the primary issuance world, there are a lot of regulatory guardrails around origination, like for example, stablecoin minting, right? Like if someone were to exploit, let's say, God forbid, the USDC stablecoin minting contract, well, by law, in the Genius Act, right, you usually have to adhere to like the Bank Secrecy Act, which has a lot of conditions around, well, it's not like Circle is going to go deliver, treasuries or the underlying like dollar liquidity to some sanctioned entity that like actually exploits that contract, right? They are bound by law to not do that. And so with RWAs, you actually have this sense of kind of governmental constraint around redemptions and things of that nature, where at least from a primary issuance standpoint, even, God forbid, something happens at the contract level for a lot of these products, there's really no recourse to actually withdraw capital from the system by any type of exploit attacker or sanctioned entity that's performing the exploit.
I was just going to make the statement that I think in a lot of situations off-chain, there's probably a lot more scams and existing vulnerabilities that are, much more than even the security audits that you can exploit today, that actually does have a transparent trail, which is really important in terms of just why things on-chain are great, because it makes it much easier to track and identify.
Oh, thank you everyone for your time. We've reached our limit here. I think this was a really insightful discussion, and I don't know if there are any questions from the audience. Great, that does it then. Thank you very much.
Appreciate it.